Welcome back. We've just reviewed an investment report on RZLV AI, that's RZLV, which was up, over 6% today. The piece argues that at around $3, RZLV is a high-risk, high-reward play, pointing to a potential gamma squeeze.
Yeah, I'm keen to dig into this one. It's trying to combine a really fast tactical squeeze idea with a much longer-term value case.
A tough needle to thread.
Very.
And the key is whether the data actually backs up both sides of that argument at the same time.
Okay, let's jump right into the most exciting part of the thesis, the squeeze potential. To really, solidify that gamma squeeze claim, the material has to go a lot deeper than just the put-call ratio.
That's spot on. I mean, it does a good job highlighting that bullishness. It cites a really low put-call ratio, something like 0.22.
Which signals a ton of call buying, squeeze.
So the analysis is sort of leaning on this one sentiment number to drive what's at its core a high-stakes, mechanical argument about market makers being forced to buy.
Exactly. It's about gamma hedging. With the dealers who sold all those calls have to buy the underlying stock to stay neutral.
And that buying creates the feedback loop, the ramp.
Yes. And if you're asking a reader to make a high-conviction trade on that, you have to show them where the ramp is actually built.
Just saying traders are excited isn't enough.
Not at all. You need to say market makers are contractually forced to buy stock at this specific price. Otherwise, a reader could just be jumping in on momentum that has no real mechanical force behind it.
So the suggestion here is to shift the focus. The analysis needs to be strengthened by identifying the exact price points where that hedging obligation gets really intense.
You have to pinpoint the open interest, the OI concentrations in the options chain. That's where the story is.
Right. You have to find where the biggest piles of call options are sitting, especially the ones that are close to the current price.
Because if the stock crosses that strike price, that's the trigger. That's when the dealer's risk spikes, and they have to run into the market and buy shares, which just pours fuel on the fire.
Without that OI map, the whole squeeze idea is just speculation.
Purely.
So, to give some concrete examples, instead of just quoting the ratio, the report could dig into the open interest density right near that technical resistance level it mentions, the $4.35 mark.
That's a huge level on the chart.
Exactly. And to really nail it down, look at the volume in OI at the big psychological numbers, $4, $5.
Show the reader the exact number of contracts sitting at those strikes.
Yeah. That gives you concrete proof of where that forced hedging, that mechanical feedback loop, is most likely to kick in.
And that single change, moving from a sentiment metric to a mechanical one, that's the difference between a guess and a high-conviction trade.
It completely changes the risk profile. It makes the entire thesis so much more robust and, frankly, more actionable.
Okay, so we've covered the mechanics of the trade, but even with perfect data on the gamma ramp, a reader can still get lost if they don't know how to place that trade within the bigger investment picture.
Which brings us to our second point, which is really about the structure.
Mm-hmm.
The way the piece blends the fast squeeze play with the long-term value argument could confuse the audience. Separating those narratives would create a much clearer path for different types of readers.
This is a critical point. On the one hand, it's framing RZLV as this rapid short squeeze candidate.
And on the other, it's talking about a long-term growth story aiming for, $500 million in annual recurring revenue by 2026?
Those are two completely different investment mandates.
Completely, and that dissonance happens when you jump straight from a metric like days to cover.
Which is very low, by the way.
Right, very low. And you jump from that to an analyst price target of, say, 1079. That's a multi-quarter, maybe multi-year projection.
Can we just touch on that days to cover point? Most people hear short squeeze and they think of a high days to cover. Shorts are trapped for days.
Good point. But here, the low number actually supports the gamma squeeze thesis. It's not about trapped short sellers, it's about trapped market makers.
Right, but the report doesn't quite make that distinction clear before it pivots.
No, it just segues from that low days to cover to a 200+% upside target. And the reader is left thinking, wait, is this a quick flip I need to get out of at $4.35?
Or is it a fundamental investment I should hold for 2 years to see that full upside?
The capital you use for those two strategies is totally different. One is risk capital for a trade, the other is core investment capital for a long-term hold.
So the suggestion has to be restructuring the piece. You need to clearly draw a line between which data points matter for the short-term trade and which ones support the long-term investment.
It just aligns the piece with what the reader actually needs.
Absolutely. And you could do this with something as simple as, say, 2 distinct summary boxes.
Or just separate sections, label them explicitly. For the momentum trader, you focus only on the mechanics.
The low days to cover, that critical 4.35 resistance break,
Validated by the options OI we just talked about.
and the RSI momentum shifting out of oversold territory. That's the trader's entire world.
And then for the long-term investor, you concentrate on the fundamental belief system.
The credibility of that $500 million ARR guidance.
The strategic alignments with Microsoft and Google. And a detail I saw in the report, the earnings date being pushed to January 2026.
Which is a huge tell. That gives the long-term thesis room to breathe, but it's totally irrelevant to a trader trying to catch a 20% move next week.
By separating them, you let the reader choose their own adventure. High-risk short-term trade or, a medium-risk long-term growth play.
And you give them the right tools for whichever path they choose.
Exactly. Now let's turn to that fundamental side, because that's where the long-term conviction really has to be earned. The third big opportunity we saw is about building a much stronger justification for those incredibly aggressive growth targets.
Yes. To make the fundamental case stick, the material has to build a clearer bridge explaining how these big strategic partnerships translate specifically into that $500 million ARR target.
The report does a great job of identifying the two catalysts. You have the massive ARR target, which implies a growth rate way faster than most AI peers.
And you have the validation that comes from working with Microsoft and Google.
But the connection between the two, the mechanism, how does that validation actually accelerate the revenue? That part is just assumed. It's not really explained.
And that's exactly where the bear case comes in. A skeptic can easily look at that and dismiss the $500 million target as just hype.
Especially for a stock trading down at $3. The market is clearly not pricing that in right now.
Not even close. So, the suggestion is to bolster the significance and relevance section by providing a framework for that growth. You have to tie the market validation directly to customer acquisition or, say, average contract value.
The listener clearly has the technical expertise to do this. They could just do the math for the reader. For instance, outline one possible scenario. What does it actually take to get to $500 million ARR? Does that mean landing, 50 new enterprise clients at $10 million a pop?
Or does it mean a massive sudden increase in contract value from existing customers?
Just doing that simple calculation would anchor the whole thesis in reality.
Or, another way to go, they could explain precisely how the Brain Suite integration with Microsoft or Google helps them acquire customers faster.
Right. Does being in their ecosystem automatically expose RZLV to a whole new tier of clients?
How does that partnership fundamentally change the velocity of their sales cycle compared to their peers?
That connection, that's the missing link. That's the anchor for the entire long-term value thesis.
If you can build that credibility bridge, that mathematical or strategic roadmap, the argument shifts from just being aspirational to being analytically supported.
It makes sure the catalysts aren't just bullet points on a slide. They become logical, achievable steps toward that massive growth.
Exactly.
So that brings us to the end. We've really hit on 3 key opportunities here to make this report on RZLV have a much bigger impact. First, strengthen the gamma squeeze argument with specific open interest data, looking at key strike prices. Move beyond sentiment to mechanics.
Second, restructure the piece to create a clear separation between the short-term trading narrative and the long-term investment thesis. It lets the reader align the data with their own goals.
And finally, build that concrete credibility bridge for the fundamental case. Justify the aggressive $500 million ARR target by showing how the partnerships with Microsoft and Google make it possible. Do the math.
If you implement those suggestions, what you'll have is a truly robust, logically sound analysis. It will give the reader real confidence in both the tactical squeeze and the fundamental value. It's all there. It just needs that sharpening to really hit home.
We look forward to seeing the revised material. Please feel free to submit it back to us for a follow-up. Until next time.